Hello everyone, my name's Cole. I'm one half of the Technical Trade Sync YouTube channel along with FaZe, and this channel is going to be us sharing our knowledge with you about the market, how to analyze it, and bringing you along the journey of investing. Now, we're going to be starting off with some basics such as financial statements, balance sheets, cash flows, and bringing you along the journey of investing with us. Now, this channel is going to be tailored mainly to beginners when it comes to investing, but down the road, we're going to be branching out into some more technical sides of things, and hopefully, it will be tailored to everybody in the future. Now, we're going to keep videos about 10 minutes or less just to help keep the information concise so that we don't lose your attention, and just to avoid any emotional decisions when it comes to investing your money into companies. Now, we hope that we can bring you along on this journey and help you make some good decisions and help you eventually grow your money. So, without further ado, let's get into this channel.
What's up, everyone? This is my channel, Technical Trade Sync. This channel is just going to highlight how a beginner could look into the stock market and make decisions on possibly looking into buying stocks or just learning. I do want to start off this video by mentioning that this is by no way advice on what you should put your money into, just suggestions on things that I myself and Cole will do, just for you to see a new way of kind of looking at things. I find a lot of times people do, look into the markets based off of what others are saying. I feel that it's better to have more of an analytical approach that could take maybe 15 max 30 minutes overall is probably going to help you make a wiser decision and know that it's up or down. You made a decision based off of actual metrics. Now, for this video, we're going to be running over a financial statement, specifically balance sheet for the company Apple. This will allow you to see how we see the markets, and eventually, once everything's been covered for the technical side of things, we're going to then actually do live buys of companies that we think are going to be worthwhile for everybody. Without further ado, I have the balance sheet already popped up for Apple Incorporation. Before we begin, I just wanted to mention that it's in millions, so all the figures that you see are going to start off with a million. And when you're looking at a balance sheet like this, if you do not know, 5 right here for this cash and cash equivalents is 5 million, which would mean that this right here is 25 billion and 29 billion respectively. I'm comparing this balance sheet to June 29, 2024, which is the last quarterly reporting, to September 30th, 2023, which is the end of the year reporting. This is kind of a nice metric to kind of compare where Apple's at once the year is over. It's considering today is September 10th, and in about 20 days, we're going to get the year-end reporting. Based off of that, you should make your review on what's kind of happening with the company. iPhone 16 has launched now, so this is prior to that. And when you're looking at the balance sheet, there's a lot of things in here. These are called line items. These line items can be confusing because they're technical terms, and again, I want to bring this down to as simplistic terms as possible. So assets, liabilities, and shareholders' equity. 3 sections that you'd want to look at that are present in the balance sheet. You don't want to look at every single thing because in the beginning of the video I said it's going to be 15, 30-minute analysis. And just by looking at it roughly quickly, if you see that where the performance is at as of June to September, it's not too far off that by the end of the year, the financials, your cash and cash equivalents are going to be a lot higher than last year. So nothing looks too off, and you're seeing that okay, there's not an alarming drop in a line item. Again, line item being what I'm saying here. And this is very standard, so I'm just going to quickly mention that accounts receivable is just going to be Apple hasn't received money for services that they've provided. This account going down in value is a good thing, for instance, just because you don't want to have people owing you money for too long, because then the likelihood of people actually paying you in the time frame that you're wanting is going to go down. A lot of times accounts receivable when they go over 90 days is going to be considered a stale receivable, and because of that then it becomes a doubtful account. A doubtful account is the doubt that the vendor is actually going to pay you or whomever that owes you money. So think about it, your personal life, somebody owes you money, they're not paying you back for a while, then you become doubtful for it. When you're looking at stuff such as inventories, it's just exactly what Apple has an inventory for, let's say iPhones or MacBooks, etc. This going down is also a good sign that they're actually converting their inventories and selling it. Now, you see that it's at 6.1 billion and 25 billion is the cash for it. It doesn't retrospect mean that when you're selling inventory that it's going to convert to cash instantly. They use it for multiple purposes. So do not confuse that inventory is going down. Why is the cash not going up? Keep it as simple as possible. And put yourself in the shoes of your balance sheet when you're looking at something like this. Just because when you're looking at, when I mentioned receivable, now inventories, think about what you have in personal life as somebody, again, as I mentioned, owing you money or inventories that you have. Anyways, moving forward, we have marketable securities. Now, when you look at this whole thing, you can Google this, but to keep it short and simple for this video, is essentially what Apple can convert into stocks or cash in the long term perspective of things, and that's went down in value. Now, again, this could be investment in other things, and long-term assets, you can kind of see that they have jumped up their property, plant, and equipment. They have also jumped up their other non-current assets in, again, in comparison to last year. So it kind of makes sense why there's a drop of $9 billion, but also an increase in property, plant, equipment, and other non-current assets. This is probably what's going to happen again in the year end too, but make this thing make sense so that you know that this company is liquid, it doesn't have too much debt, and also it's just performing on a quote unquote healthy basis. And with having mentioned debt, we have liabilities and shareholders' equity. With current liabilities, you have accounts payable that's going down. That's a very good sign for Apple. It means that they are paying off current liabilities, is again just like current assets, anything a year and under, maximum a year. So they're paying off their dues very efficiently in comparison to last year. So it's 47 billion versus 62 billion. Then other current liabilities could be anything. So there's just term debt incorporated within the other current liabilities, and that's going up. Not by a long shot, so it's fine. Deferred revenue is Apple has provided. Apple is doing they do money to other vendors, and the services have been rendered to them about the same. When you're looking at term debt here as the last line item, that's short-term debt, a year or less, and that's actually went up. Now, that's not the worst thing in the world. For big corporations like Apple, when they're taking on debt, it's for ventures that they want to take on instantly. And with that going up, they're using debt to fund their resources of some kind because of the rate that they might be getting, because of however it's looking. Keep in mind, this is as of June 29th, 2024. Interest rates are cooling, and based off of that, maybe Apple is taking on the ability to say, we're going to take on more debt because interest rates are more favorable, as opposed to last year. As you know, we're still recovering from COVID as an economy with inflation, and so it's better now to take on debt. Keep in mind, when you're looking at these, again, relate this to the economy of current society, related to what's going on around the world. That will give you an impact on how companies are impacted as well, and give you an insight. When you see, again, a big increase, a big drop, look into why that's happening overall with the economical standards, or also the sector that it's in. This is tech, so see, maybe tech's taking an impact with what's going on. Now, last but not least, we have shareholders' equity. Common stock is, again, what you and I might buy for Apple. There's common shares and there's preferred shares. When we buy, that's common shares. This is a very good sign. The 79 billion shares versus 73 billion shares. That means more equity is being put into the company based on the fact that so many people are buying the shares of said company, which increases the market capitalization that you may have heard of, this term everywhere. Market cap going up just means that more people are buying shares of said company. Now, in this case, Apple. And based off of that, you see that they have accumulated deficit. That's gone up. This is very good for a shareholder of Apple, which means dividends are being paid out. paid out so much so that they have actually increased in 4.7 billion from 214 million. Now this is not alarming. This is wonderful for somebody owning a share of this company. It means the value of your share is actually worthwhile because you're getting paid every quarter a dividend. Dividend is something that we'll discuss in future videos, but essentially dividend is a percentage of a share that you own. You get money just given to you for owning the share, to keep it short and simple. Overall, the most important things that you want to take a look at for a balance sheet for when making a decision of that as a performance of a company, you want to look at working capital, you want to look at short-term liquidity, asset performance, and capitalization structure. Capitalization structure is a fancy term that just means the amount of debt versus equity that a company has on its balance sheet. Having said that, you just take a look at where the equity is lining and where the debt is lining. And as you can see, when you're seeing the performance of Apple, you see that it's healthy. I keep using that word because this is a very standard term being used as any analyst would use, that this company is worthwhile for a long-term investment. And this is again what I would do if I was looking at Apple, if I was only making my decision on balance sheet, which obviously is not going to be the case. But it's a very well performing well oiled machine. So now I kept this very simple. I haven't gone into too much detail that might throw your attention span off. I If anybody has questions, of course, ask in the comments below and I can answer it. Again, these entire videos are going to be meant for people that are brand new, that don't know much, just want to learn, and then have an idea of what the markets do and how they perform. But the idea behind this, I think, is a lot of times companies like to have a big pump in the performance of the stock, and then you'll hear about it in the news. I know the GameStop frenzy, people talk about it all the time. That's one, right? Now, when you look at a financial for a GameStop, you may see that it's not actually a healthy company. Or when, for example, a company like Shopify. Shopify's value in 2018, 2019 was at well over $1,000. But then when you look at the financial statements, any person analyzing this company would say, how? That's called a pump. Everybody's buying something without the basis of anything. But when you buy things on the basis of something being a financial statement, you're going to have a decision where it's going to benefit you in the long run. And you'd rather take a consistent growth as opposed to a pump, because you never know when it's going to go down when you wake up. Whereas a consistent growth company like Apple will have its performance every year and you'll know what you're getting out of it. With that being said, when I look at the Apple stock, we'll be looking at this quite consistently. Just the overall performance of said company. And this is on the day. Year to date, you're getting about 16. My apologies on this. A year to date, you're getting about 16.20% overall. 5 years, you're getting 306%. All time, you're getting 169,000%. Now, I don't imagine anybody's buying it back in 81. Some people might be, but for beginners like us, maybe not, obviously. But you're seeing, even with the year, you're getting a consistent growth. Take out 5 in 1 day or 5 days. But this is what you'd want out of a company. And if you have 10 of these, 15 of these that you've found with analytical, technical review, you're going to end up performing well. Whereas again, with GameStop, as you saw, it was up and then it was down. So anyways, I wanted to keep this video short. If you have questions regarding specific line items and you want me to comment on it, I can. If there's any feedback for somebody that might say that I have some lack thereof explanation and I need to explain more, please let me know, as I am also a student of the game and I would love to learn more. But this is basically just going to be a journey on how I look at things before making decisions, and then you'll see performance as well. Thank you so much for watching this video. You all have a great day.